Hello everyone. Today on our YouTube channel I will tell you about this type of investment, like investing in stocks. Warren Buffett, George Soros, Bill Gross, Larry Williams. This is a list of well-known multimillionaires who made their fortune in the stock market. It is really possible to get rich on the stock exchange, but a real trader is distinguished not by the ability to catch a trend at one moment, but above all by the ability to receive a constant and stable income from his activities. If you really decided to find out what the stock market is and make a profit, then it is worth going through a few steps. And the first of them is acquaintance with market instruments. Let's start with the most hot commodity on the stock exchange: stocks. What is a stock? A share is a security that gives its owner the right to participate in the management of the company and receive a part of its profits. By buying a share, you are, in effect, acquiring a piece of the company. If this corporation works and makes a profit, then they work together with it and bring income and your money, both thanks to the growth of stock prices in the long term and in the form of dividends. Why do companies issue shares? Business, especially at the stage of development, needs funding. The authorized capital for the implementation of new projects is not enough, and the company needs funds. To do this, a company can take out a loan from a bank or issue bonds and become a debtor to their holders. But there is another way to attract financing: selling part of your own business in the form of shares. Thus, the company gets the opportunity to develop and receive additional profit at the expense of investors, and shareholders also receive income through the development of the business of which they are a part. What does owning stock give you? The company can issue two types of shares or be limited to only one. They call them ordinary and privileged. The main difference between these categories is in the order of profit and the ability to influence the adoption of important decisions for the company. In any case, it matters how many shares are owned by the shareholder. So, by owning one share, you get the basic rights of the owner of the company: participation in management, participation in shareholders' meetings, the right to dividends, and to compensation in case of liquidation of the company. And by owning 2%, you can already nominate your representative to the board of directors. How to make money on promotions? It is clear that an ordinary market participant does not have enough securities to directly or indirectly influence the fate of a company. But in fact, he doesn't need it. The main purpose of buying a stock is to make a profit. And he can earn in two ways: by receiving dividends or income from the difference between the purchase and sale prices of shares. Buying and selling shares. Anyone can trade shares. To do this, he just needs to open a brokerage account with a broker, deposit funds and start making purchases. You can make a deal in several ways: by calling the broker and submitting a buy-sell voice order, or using special trading systems. The difference between buying and selling a stock is your profit. Bought cheaper and sold more expensive. But in reality everything is not so simple. Investing in stocks can bring both income and loss, and for your investment to be profitable, there are many parameters to consider when choosing assets. We will tell you what you should pay attention to first when buying shares, especially if you do not have experience and special knowledge. The financial position of the company and the valuation of its shares. There are different parameters when choosing a stock to buy, but one of the main ones is the financial performance of the company whose stock you are going to buy. After buying a share, you become the owner of a piece of this company and are interested in the success of the business. Usually every quarter, companies publish their financial statements. It is on this basis that shareholders and potential investors can judge how much the company has earned, how it is going to develop its business further, what risks exist. In addition to indicators of revenue, profitability and net profit, there are others in the reporting, the significance of which the novice investor has no idea about. In this case, it is better to turn to professionals. Each brokerage and investment company has a staff of analysts who specialize in specific sectors and closely monitor the company's financial position. In addition, using various market multiples, they assess the attractiveness of not only the company itself, but also the growth or fall potential of its securities. Follow the news. The stock market is a living organism that is sensitive to both external factors and internal changes. It functions at the behest of hundreds of millions of people who make this or that decision every minute. But it is these decisions that are reflected in the stock price and lead to an increase or decrease in quotations. We have repeatedly witnessed how some paper at a certain moment just rolled down like a wheel or took off by 10%. Often the news was the driver for such abrupt movements. The ability to correctly assess the impact of a certain event on the fate of the paper will not only avoid losses but, on the contrary, can open up an opportunity for successful investments. Let's not forget about liquidity. The liquidity of a stock is a very important indicator. The degree of liquidity of the asset determines how long it will take to carry out the operation and what losses will have to be incurred when making a transaction for the purchase and sale of shares. Thus, the high liquidity of securities allows them to be sold quickly and without significant losses. Having noticed a company you like, it is worth asking about the liquidity of its securities. To do this, pay attention to the trading volume and spread, that is, the difference between the buy and sell prices. A large trading volume and a small spread is an indicator of a highly liquid security. You can also use a special indicator to determine the share of securities in free circulation. The free float coefficient. A low free float means that few stocks are available to private investors, so liquidity will be low. Dividends. Another way to make money on stocks is to receive dividends. Dividends are the regular payment of a portion of a company's profits to shareholders. Each company has its own dividend policy, and not all corporations are ready to pay high dividends to their shareholders. Payments directly depend on the company's profit. You bought a piece of the company and you have the right to count on a part of its income. Only in rare cases will a company that suffered a loss in the current year pay dividends from retained earnings of previous years. How to choose companies whose stocks will bring good dividends. Study the history of the company. Before you start building a dividend portfolio, first of all, get acquainted with the history of dividend payments of potential candidates. For example, there are companies that have never paid dividends, so it is hardly worth hoping that the issuer will suddenly start distributing part of retained earnings. Such cases, of course, do happen, but usually the company announces in advance changes in its dividend policy in order to stimulate investor interest and increase demand for securities. Therefore, choose in your portfolio companies that consistently pay dividends and, despite the deteriorating market conditions, continue to generate profits. Check out our dividend policy. In addition, do not be lazy to read about the company's dividend policy. This information can usually be easily found on the issuer's official website. It is there that it is described what part of the profit the company undertakes to direct to dividends and how many times a year will be paid. Be sure to pay attention to the guaranteed dividend payments, which can be a fixed amount or a percentage of net income. At the same time, it is necessary to watch out for reservations, which can, for example, cancel payments in the event of a net loss or deduct from the amount of net profit participating in the calculation of dividends, paper income associated, for example, with the revaluation of assets. Calculate your dividend yield. By opening a bank account, for example, you can determine how the amount of your deposit will increase over time. With dividends, things are a little different. The share price is not constant. Therefore, in order to understand what kind of profit dividends can bring you, dividend yield is calculated. To do this, divide the dividend amount by the share price at which you buy it and multiply by 100%. Let's look at an example. You have 1,000 common shares that you bought in early 2020 at $125 per share. Following the results of work in 2016, the company paid dividends in the amount of $7.89 per share. It turns out that your dividend income was $7,890, or 6.3% per annum. How not to miss out on a dividend. Recommendations on the payment of dividends and their amount are given by the board of directors, and the final decision is made at the general meeting of shareholders. The board of directors also determines the closing date of the register, the so-called cutoff, the date on which one must own shares in order to receive dividends. To receive dividends, you don't even need to hold shares all year. It is enough to own securities on the day the register is closed. The time of register fixation is the end of the operating day of the register closing date for dividends. If you were the owner of shares during the specified period, then the funds must be credited to the brokerage account within 25 days from the cutoff date. Which tactic should you choose? Millions of securities trades are made in the stock markets every day. A huge number of participants are involved in the auction, and each has its own strategy. To choose the right approach, you need to define your goals and capabilities. In the securities market, it is customary to distinguish two types of participants, depending on the timing and methods of investment: medium term, long term, and short term investors, who are also conservatives and speculators. Their tactics, attitude to risk, and involvement in the process are fundamentally different. Therefore, as soon as you decide to enter the stock market, immediately decide what you will be doing: investing or speculating. These are two completely different things. Short term investor, speculator. Short investment period, from an hour to several weeks. High involvement in the trading process. Most often prefers technical analysis, but also monitors the current market conditions. The portfolio can contain almost the entire range of market instruments. Most likely, the share of low risk assets is minimized or absent at all. Often use the services of margin lending. Keeps his finger on the pulse of all market events. He knows the main factors affecting a particular asset, monitors the publication of important statistics. Changes portfolio structure frequently. Continuous speculative transactions are time-consuming. In addition, a speculator must have a high level of knowledge in the field of the stock market. In the vast majority of cases, an ordinary person who has never encountered an exchange will not be able to show a stable result without at least passing a basic training course. Without knowledge, your money will sooner or later flow into the pockets of other, more successful market participants. If you decide that this is exactly your trading style, then it is preferable to enter the market with an amount that you do not mind losing. Because first you need to understand how you deal with the market, how you accept profits and losses, that is, how you psychologically endure it. Immediately determine what level of losses you consider acceptable for yourself. 5% of funds, 10%, 50%, or even all. Medium and long-term investors. Longer investment period, from a month to infinity. Low involvement in the trading process. Uses fundamental analysis and tactics. In the portfolio, he prefers to keep highly liquid shares of well-known corporations or dividend stories, balanced by debt securities of companies with a high level of reliability. Very rarely use borrowed funds. Rarely read stock news, looks at the markets only in case of serious economic turmoil or when the deadline for a trading idea is reached. Medium and long-term investors are less exposed to risk. Even without special knowledge, with the help of the recommendations of experts and analysts, you can independently form an investment portfolio. To make such investments, it does not take much time from you, as well as special psychological preparation. For example, you can build an investment portfolio from highly liquid stocks of companies with high dividend yields. A pool of so-called dividend securities has already formed on the stock market, which promise their owners quite good bonuses this year. So which strategy should you choose? There is no definite answer to the question of who is better to be a long-term or short-term investor. Speculators risk more, but they can also make huge profits. Investors take less risk, however, and returns are likely to be moderate. Remember, this is just a conventional division. Any participant in trading on the exchange can combine both speculative and investment activities. By choosing the necessary balance of distribution of your funds between these two methods, you can indirectly manage the risk of your portfolio. The higher the proportion of long-term strategic investments with periodic dividend or interest payments, the less risk you take on. And vice versa.